REI USA, we welcome you into this very special webinar on the impact, cost segregation, and bonus depreciation, the impact on investment real estate. My name is Dave Cole. I'm the sponsor manager at REI USA, be your host for tonight. We welcome you in, and especially some of the new folks that are joining us. There will be a replay of this available on the member website. Should be in the next couple of days. So if you want to catch something again or tell your members, friends that are members about it, by all means do so. Real quick, we've got, there's always so much going on here at REI USA. We've got coming up tomorrow night, actually, evening, 7 o'clock Eastern is Private Money Made Easy with Alan Cowgill. On what do we got here? On Monday evening, 7 o'clock, Rehabbing on a Budget with Lynette Fitzpatrick. Tuesday, we've got Luxury Short-Term Rentals, a webinar on that, and that's the morning one. That'll be at 9 a.m. on Tuesday, and that's with Rachel Gainsborough. So some of the things coming up, be sure to check your calendar and all that. But anyway, we want to get to tonight's subject. Very much interesting, especially for newer investors and planning for the future. Erik Oliver with CostSegAuthority.com. Erik is the managing director with Cost Seg Authority. So why don't we turn it over to you? And again, as we do that, if you do have questions, you can put them in the chat or send them to me, and we will get to them before we finish up. Erik, welcome.
Oh, thanks, Dave. Thanks for having me. I'm glad to be here today, and glad to present on cost segregation and bonus depreciation. There's a lot of things happening with bonus depreciation that some of you guys may be aware of, and we'll touch on that here shortly. But kind of just wanted to start with talking a little bit about what cost segregation is. And in order to understand what cost segregation is, I think it's important that we understand what depreciation is. And so depreciation it's a non-cash expense that a lot of us who own real estate look to as a benefit for getting into real estate. So when you buy a property, let's say you buy a residential rental, that typically gets depreciated over 27 and a half years. So just to make the numbers easy, if it's a $275,000 building, you essentially get a $10,000 write-off every year for the next 27 and a half years. Now that write-off acts as an expense. Like I said, it's a non-cash expense that can be used to offset income. And so if you've got $100,000 of income and a $10,000 depreciation expense, you're now only taxed on $90,000 of income versus $100,000. And so the more depreciation we have, the lower our tax bills are. And so cost segregation is a methodology that's approved by the IRS that allows us to accelerate those deductions and take a larger portion of those deductions up front. So instead of taking 1/27th over 27 and a half years, what if we could take roughly 30% of those deductions in year one and then spread the rest of it out? And cost segregation allows us to do that. It's typically done through an engineering-based study where we go in and we segregate the costs of your asset. So if you think about it, Dave, when you buy a residential rental, not only are you buying the walls and the land, but you're also buying the carpet inside, you're buying the appliances, you're buying the countertops, you're buying a little bit of concrete out in the driveway. All these things can be accelerated and depreciated over a shorter life. So instead of depreciating carpet over 27 and a half years, you get to depreciate your carpet over 5 years. The challenge is when you buy an asset, you don't know what the value of the carpet in the building is that you just purchased. And so that's where you have a cost segregation company come in and segregate those costs and put them into the right buckets so that you can then accelerate your deductions. So just to kind of give you an idea of the different buckets that we segregate, you've got your personal property, your 5 and 7 year assets. Those are all the interior things like carpet, countertops, cabinetry, blinds, windows, auxiliary, lighting, plumbing, window treatments, wall coverings, etc. Your land improvements are all your exterior. So that's your 15-year asset, things like parking lots, curbs, gutters, asphalt, storm drains, fencing, outdoor lighting, trees, shrubs, landscaping. Those all get segregated into a 15-year asset. So now remember, we get to put a value to that parking lot, and now we get to depreciate that over 15 years versus 27 and a half, or commercial property is actually 39 years. And so can really front load some of those deductions. And then the category to your left there is your real property. That's your 39-year assets. That's all your structural, 39 or 27 and a half year assets, I should say. That's your steel structure, roof, walls, all the structural components of your building. That stuff still gets depreciated over that 39 or 27 and a half years. So that's kind of a real quick dive into cost segregation. I kind of want to just pull up a quick case study here to give you an idea. This is a $1.2 million storage unit facility. Now, remember, you don't get to depreciate land, and so you have to always back the land out of your depreciation calculation. So purchase price minus land equals your depreciable basis. So in this case, the depreciable basis was 1.2 million. It was for a 2020 purchase, and the tax year was also 2020. So they bought it in the year that they were doing their taxes. And you can see this is over on the left-hand side, what their depreciation would look like if they don't do cost segregation. So essentially they're getting a $30,769 write-off every year for the next 39 years. And again, that's over on the left-hand side in that blue column where it says depreciation without cost segregation. So that's 1/39th of the 1.2 million. So again, you take your 1.2 million, divide it by 39 years, essentially you're getting a $30,000 write-off every year. Now remember, that write-off goes towards your income. So if you've got $100,000 of income, instead of being taxed on 100,000, you now are only taxed on 70 by owning this piece of real estate, which is great. That's why, like I said, a lot of us get into real estate is for some of the tax benefits. But now with cost segregation, you'll see that green section there, that's the cost segregation section. You'll see at the bottom there on the right, we're still segregating $1.2 million, or we're still depreciating, $1.2 million of asset. But now we've broken it up into 5, 7, and 15-year assets, and the rest of it falls in that 39-year category. So you can see under the 5-year column there in the green section, down at the bottom, we found $60,000 worth of 5-year assets in this storage facility. There's not a lot of internal stuff in the storage facility, so there wasn't a lot there at the 5-year category. However, at the 15-year category, there's quite a bit. All the curbs, gutters, asphalt, fencing, security, lighting, all that gets reclassified into a 15-year asset. So you can see out of the 1.2 million, we determined that 240,000 of that was for 15-year land improvement. So now we get to depreciate that over 15 years versus 39. So over on the right-hand side, you'll see where it says total in the green section. You can see what your depreciation numbers look like when you do cost segregation. The first year you get 35,000, second year 65, third year 55, then 48, then 46. Versus over on the left-hand side, if you remember, we're just getting a flat 30,769 every year for the next 39 years. So by doing cost segregation, we front-loaded and created larger benefits in those first or those early years. And by the way we did that again was by segregating those assets into the appropriate buckets. In this example, by doing cost segregation, let me go back here. You'll see in the first year over on the right-hand side where it says detail of benefits, over in the blue section on the right-hand side, you'll see your tax savings. So in the first year, your tax savings was $7,054. The next year was $12,008. This is your tax savings. And the reason that is there is because you had a larger deduction than you would have had you not done cost seg. So just look there at year 2 where it says 2021. By doing cost segregation, we're getting a $65,000 deduction versus a $30,000 deduction. So we've increased our deduction by $34,000. You take that additional deduction, times it by your tax bracket. In this case, we use the 35% tax bracket. That's a $12,000 tax savings. So significant here. Now, one thing I do want you to note is up at the top there, it says no bonus. And I'm going to go into what bonus depreciation is here in a second. But in 2017, Trump was our president at the time. As most of you are aware, Trump is a real estate investor, owns a ton of real estate. and revised the tax code. And part of what was included was something called bonus depreciation. So bonus depreciation had been around for a while, but he really enhanced the benefits of bonus depreciation. So in the past, bonus depreciation was used to kind of stimulate the economy. And the whole idea behind bonus depreciation was if you went out and bought something that was brand new, a brand new tractor or a brand new piece of equipment, if that piece of equipment had a useful life of 20 years or less, and it was brand new, you got to take bonus depreciation on it, meaning you got to take more depreciation in the first year than you normally would have. So, for example, let's say you buy a bulldozer. A bulldozer, let's say it's a 20-year asset. And let's say you paid $100,000 for it. You would get a $5,000 write-off every year, or 1/20th of that every year for 20 years. But under these bonus periods, if you bought that within a 50% bonus period, you would get to take 50% of that, or $50,000 of that in terms of depreciation in the first year. And the remaining 50,000 would be depreciated over the next 19 years, because remember, we said a bulldozer was a 20-year asset. So you're getting 50% of your deduction in year one and spreading the other 50% out over the next 19 years. And you'll see here, it was kind of tricky because every year over in this little chart here, you'll see that the government would kind of, depending on how the economy was doing, they would kind of adjust this bonus percentage. And the whole idea was to encourage people to go out and invest in new equipment, new machinery, et cetera. Remember, bonus can only apply to an asset that had a 20-year useful life. So real estate, like we mentioned, is 27.5 years or 39 years. So it doesn't really apply to real estate unless you do a cost segregation study, because we're segregating stuff into 5, 7, and 15-year assets, which now all fall under 20 years. So this was the old tax law. It had to be brand new, and it had to be 20 years or less. And you would get these percentages here. Under the new tax law, any property purchased after September 27th of 2017 through the end of this year, 2022, so December 31st of 2022, is now eligible for 100% bonus. So again, this was part of the Tax Cuts and Jobs Act, and it no longer has to be brand new equipment. It can be new to you as the investor. So let's kind of walk through what that means. I can go out and buy a building that, let's say the building was built in 1970. I can go buy it today and have a cost segregation study done on that building. And let's say I buy it for $1 million, and in the cost seg study, they find $300,000 worth of short-term assets 15 years or less. I get to write off those 15-year assets, those 5-year assets, those 7-year assets, 100% in the first year. So essentially, I'm getting a $300,000 deduction in the first year on $1 million purchase. And I'll kind of walk through how that works here. So let's go back to that $1.2 million storage unit facility bought in 2020. If on the old chart, if you remember that green section, that $60,000 there underneath the 5-year category, that was split up over 5 years. Essentially, you're taking 1/20th. It's not quite 1/20th. There's some different math in there, but essentially you're taking 1/5 of that every year for 5 years. Your 15-year assets, you were taking 1/15 of that $240,000 every year for the next 15 years. But now under bonus depreciation rules, now you get 100% of that in the first year. So if you look over to the right-hand side of that green column, you'll see the total. That's your total deduction for the first year. You're getting $311,000 of deduction, which is massive. That's unheard of. If you don't do cost seg, you're getting a $15,000 write-off over on the left-hand side where it says depreciation without cost seg. And remember, what we're doing is we're just front-loading your depreciation. You'll see in the second year, under the cost segregation, the green section, you're getting a $23,000 write-off. Versus if you don't do cost seg, you're getting a $30,000 write-off. So you're actually getting $7,000 less in year 2. But the whole idea is give me my deductions now. $1 today is worth more than $1 tomorrow, especially in today's world, Dave, where inflation is nearly 10%. $1 today is worth, more than it's going to be in the future, let alone in 39 years from now. So give me my deductions now. let me go reinvest them, let me pay down debt. There's a number of things you could do with those deductions. But give me my deductions today. So summary of this is on that same property, when you apply the bonus depreciation rules, your increase in depreciation is now $296,000 of extra depreciation, which results in $103,000 tax savings. Now, again, that's assuming you have income of $296,000 that you can offset. And so you want to make sure that that's the case. For some of us, whether we're real estate investors on our tax return or not, real estate professional status is an important element to this cost segregation. So I'll just touch on that quickly, Dave. But what it is when you, let's say I'm a doctor, that means that my active income is my day-to-day job, which is me being a doctor. But I also have a few investment properties because I make good money as a doctor. I've got a few investment properties on the side. Those investment properties, that's considered passive income. So you've got my active doctor's income and you've got my passive real estate income. If you do a cost seg study on your real estate, those deductions cannot be used to offset my doctor income because those deductions are considered passive deductions and can only be used to offset passive income. So what we see a lot of professionals do, you think about doctors, lawyers, high W-2 earners, is they have their spouse become the real estate professional and they file a joint tax return and now all that becomes active. And so, again, I'm a doctor, but let's say my wife, because I have high W-2 income, is able to stay home. She manages my real estate or our real estate. She manages it. Because she manages it and spends, there's some rules to becoming a qualified real estate professional. You have to spend 750 hours a year doing real estate. And then you also have to spend 51% of your working time doing real estate. So if you have a full-time job doing something else, you're probably not going to qualify as a real estate professional. The IRS isn't going to believe you when you say you work 40 hours a week as a doctor and another 41 hours a week as a real estate professional. They're not going to believe you. So your spouse becomes a real estate professional, spends roughly, it's the 750 hours is about 14 hours a week. And that's all they do. Now the deductions I create from my real estate activity can be used to offset my doctor's income. So again, if let's say I'm making $500,000 as a doctor, I go buy a storage facility. Instead of me being taxed on $500,000, I'm now only taxed on $200,000. That's a savings of about $100,000 in taxes. So you know what I do with that $100,000? I go buy another storage unit. And I keep doing that. Instead of me paying Uncle Sam, I'm now investing in my real estate portfolio with that money that normally gets written as a check to the IRS. And so it's important to understand and obviously always consult with your tax preparer when looking at becoming a real estate professional. But if you can become a real estate professional, it kind of opens or changes the rules in terms of how you can use this depreciation. And so if you're not a real estate professional, you can still use these deductions, but you can only use it to offset the income from your real estate. So if you just have one property and your property is not generating a lot of income, it may not make sense to accelerate those deductions, at least now. You know, cost segregation is interesting. It's one of the few tax strategies where it's not a matter of if, it's just a matter of when. When do we play this card? When do we do cost segregation? And it's flexible. A lot of things are not flexible when it comes in terms of using your deductions. You either have to use it or you lose it. But cost segregation, you can kind of keep these in your back pocket and say, okay, I had a high income year. I had a lot of rental income. I need something to deduct. So now I do cost segregation and I bring that taxable income down to something a little more manageable into those lower tax brackets. So we oftentimes get asked, have a property that I've owned for a number of years, can I do cost segregation? And this is interesting. I actually had a client today whose CPA said, oh, it doesn't apply to you because you've had your property since 2019. And that's just not the case. The IRS allows us to go back and do what we call look back or catch up benefit studies for properties that you've owned in previous years and you still own them. So let's say I bought that same storage unit in 2019. I can still go do a cost segregation study on it. Tell the IRS, hey, I've been taking my standard deduction. I'm now going to accelerate my deductions. And here's the difference in those two numbers. And I get to drop that on my current tax return. There's a form that you have to fill out. It's a 3115. We actually provide it as part of our service. But you fill that form out, you attach it to your tax return, and it allows you to take that deduction in the current year. So this is that same example of a $1.2 million storage unit, but now let's say I bought it in 2015 and I'm doing my taxes in 2020. So I've owned it for 5 years. You'll see there in that red circle in the green section that I get to take all that missed depreciation I should have taken over the last 5 years and drop that on my current tax return. So now I'm getting $123,000 write-off on a property that I've owned for 5 years. That $123,000 write-off times a 35% tax bracket, that equates to a $43,000 tax savings. So again, if you're an investor out there and you've got real estate and you've owned it for a number of years and you're paying taxes, it's definitely worth looking into. I'm just going to check the chat here, see if we've got any questions.
Yeah, actually, Eric, I've got do have a couple of them already that were sent to me directly. So this one's actually a two-parter, and you can see how they relate from Lewis in Tennessee. He wanted, and it's actually a good idea to do that. You mentioned about commercial cost segregation can be 39 years. And the question always comes up, and it did as the first part of this, is by commercial in this case, does that mean like multifamily above 4 units or 6 units, or it's the old defined commercial? And the next part of the question, and I love our members, they come up with some great questions. In the event of 39 years, or in some cases, even with the 26 years, so we have people that are investing their IRAs or 401ks, retirement funds into this. So if it's a 26 or 39 year plan and they're in their 50s at that time, does a succession plan or an inheritance of the property, does that have an impact on the cost segregation and the eventual tax benefits?
Sure. No, those are two great questions. So
yeah,
commercial versus residential is a little bit confusing because depending on if you're a realtor or a tax professional, it has multiple definitions. So let me clarify. Residential for depreciation purposes is a building that somebody lives in. So think about it could be a 700 unit apartment building. People live in there, they're there night and day. That gets depreciated over 27 and a half years. So all your single family homes, duplexes, triplexes, senior living centers typically get treated as 27 and a half year assets. 39-year assets are anything that's open during the day, all your all your retail, office buildings. If you think about it, that makes sense. Those assets are going to last longer because they're only being used 9 to 5 versus a residential building that's being used potentially all day long. So that's kind of where the IRS looks at it. If somebody's living in the building, it's typically treated as 27 and a half year versus 39 year for your commercial stuff. Regarding the IRAs, that's a good question. So IRAs, cost segregation doesn't necessarily apply if you're using retirement funds because you're not being taxed on that. And so there's no need to reduce your tax liability. So great way to invest in properties, but again, you're deferring your taxes. And so you don't need tax write-offs now. So definitely wouldn't recommend, well, you can't use your deduction. You don't get to take depreciation if you're using IRA or self-directed IRA funds.
But still, if somebody is, they're not investing then through their IRA, and I guess the other point of the question is, so they're in their 50s or older, and it's still a 26 or 39 year plan. What happens in the event of succession? Because I know sometimes with inheritance or different ways of succession, that could affect things. So is there a way to take it early? I think that's the gist of the question. How does it work when you're not looking to be in this for that many years?
Yeah, so you can still do cost segregation, and the exit strategy, there's a couple of ways. One is a lot of investors will defer, and then unfortunately we all die and we pass these properties down to our heirs and they get a step up in basis under the current tax law and pay no taxes. So that's one way. That can be done through 1031 exchanges where you defer your capital gains, you defer your recapture. defer, die, nobody pays taxes. That's one way. The second way would be with a cost seg study. If you plan on holding the property, you can take, we get often get asked, and I'll touch on this here in a second about recapture. So when you take depreciation, you have to pay a portion of it back in the form of recapture or capital gains. And so if you hold the property until you pass it on to your heirs, then you don't have to pay capital gains or recapture, which is great. They get a step up in basis. If you do have to pay recapture is an ugly word that people get nervous about because they're like, well, why am I taking all these deductions up front? Don't I just have to pay them back? And actually, I think that's the next slide. Let me just advance here. Let's see. Yeah, I went through that. I'm going to.
You're ahead of your time once again.
There we go. So let me touch on this on when you would do a study, and then I'm going to get into the recapture. But we get asked, when would I do a study? If you currently own an income property, if you purchase a new or existing building or build a new building, if you renovate, or if you significantly renovate, remodel, or make leasehold improvements, before you sell an asset, and if there's a step up in basis. And let me kind of go through that. People, like I said, have questions on, what do you mean before I sell? Don't I just have to pay it back? If I take all my deductions and I sell the building this year, don't I have to pay it all back? And this gets to your question of recapture. When you take a deduction, the idea behind cost segregation is you're going to take your deduction this year at your highest marginal tax rate. So let's say I'm in a 37% tax bracket in a 5% state. So I'm at a total of 42%. I'm going to take my deduction at 42%. If and when I sell the asset, I'm going to pay it back at a recapture or capital gains rate that's no more than 25%. And I'm going to save the spread. So even if I have to pay it all back, I'm still saving the difference between 37 and 25%. Okay, in that example, it's 12%. The idea is, though, you're not actually paying it all back. And this is where I think the light goes off for people, is when I kind of back into this and say, okay, let me ask you this. Let's say I buy a property and I pay $1 million for it. And 5 years later, I sell it for $2 million. Okay, market's great, doubles in value over 5 years. When I go to settle up with the IRS on that transaction, I'm telling the IRS that everything doubled in value. My land is double, my walls are double in value, and so is my dirty old carpet that's in that apartment building. Well, that's not the case. Carpet doesn't go up in value. Carpet goes down in value. But when you don't cost segregate the assets, when you don't break the assets out, you have to treat it as one big asset, and you just tell the IRS, hey, I bought it for $1 million. I sold the whole thing for $2 million, so I owe you money. I owe you the capital gains on $1 million. And that's, again, not the case. So by segregating, you're breaking out the 5, 7, and 15 years. If I own the property for 5 years, Dave, what are those 5-year assets worth after 5 years? Zero. They're not worth anything, right? They're fully depreciated. I'm not going to sell my dirty carpet for more than I bought it for 5 years ago. That seems crazy. But if you don't do cost segregation, you have to do that. You don't get to allocate your sales price to the right bucket. And so that's kind of how recapture works without getting too far in the weeds, is it allows us to allocate our sales price to the right bucket, and it lowers our tax liability upon sale. So I've actually got an example here. This is the example I was looking for. Apartment purchased in 2015 for $2.5 million. We sold it 5 years later for $3.3 million. So typical real estate transaction, there's hundreds of these happening across the country right now. Your total tax bill, without getting too far into these numbers, is $285,000. So you bought it for 2.5, you sold it 5 years later for 3.3, you owe the IRS $285,000. I've never had to write one of those checks, Dave. One day, hopefully I will, but that means you made money off the deal if you have to write that big of a check, which is great. You could have made $800,000, but you got to give the IRS their $285,000. On a cost segregation study, because we've owned it for 5 years and we segregated out those 5-year assets, we don't have to pay gain on those 5-year assets now because they're worth zero. So exact same example, you just see that we've broken it up into the different buckets. Your total tax bill on this by doing a cost seg study when you sell it is $203 versus $285. So you saved $81,000 in taxes upon selling that asset. So not only, I did the cost seg study in 2015. So not only did I hold on to that money, reinvest it, buy new properties, but then when I sold my asset, my tax bill was reduced by $81,000. So I won't get into all the numbers here. I mean, it took me 3 years to learn this, Dave. I don't expect you guys to learn it in the next 30 seconds. But just know this, you're not paying gain on your dirty old carpet. If you can remember that, that's kind of how this works. And so by, excuse me, by segregating, you get to allocate your sales price to the right buckets, which allows you to manage your recapture and manage your tax bill upon sale. And so this is a great example of, like I said, an $81,000 tax difference. Those are tax dollars, dollar for dollar tax dollars, not deductions. And so that's a significant number there by taking your depreciation in the early years. All right. Let me just check the chat here, see what we've got.
All right. Yeah, actually, I've got another one. So the question becomes, and I'm sure this applies to a lot of our members that are in the looking at properties, considering the investing stage. So is there something to look at in terms of thinking ahead toward cost segregation? So maybe you're comparing a, one property over here versus another one over here. Is there certain criteria that you might look for before you purchase that would bring you this additional advantage? Or is it strictly the, what you're making at the time you sell that's going to happen later on and it doesn't affect?
Sure. No, there's definitely different asset classes that generate different results from just strictly a cost segregation standpoint. So multifamily is a great category because you think about multifamily, you've got a whole lot, you got a 50-unit apartment building, you got 50 sinks, you got 50 garbage disposals, you got 50 washers and dryers. And so there's a lot that can be segregated in multifamily. Typically, we segregate around 30 to 35% in multifamily versus like an industrial building might be somewhere closer to 20 to 25%, just because, an empty warehouse with a cement floor, you're not going to get the same kind of personal property inside the asset. So when you're looking at investing, there are a few categories or a few asset classes that are unique. One of them is car washes, gas stations, and then mobile home parks. Those three asset classes, depending on the layout of the land, it's not always the case, but oftentimes you may be able to depreciate 100% of your purchase price in the first year. So car washes, for example, can often be classified, the whole car wash, as a 15-year asset. It's land improvements and it's equipment, and that all gets classified as 15 years. And remember, the bonus rules say that any asset under 20 years is eligible for bonus, and under the current law, it's 100% bonus. And so you could basically essentially buy $1 million car wash and have $1 million deduction in the first year. And I should touch on that, Dave. We talked about bonus. Bonus is sunsetting. That's part of the tax law that was written at the time. Anything purchased from September 27th of 17 through December 31st of 2022 is eligible for 100% bonus. Starting next year, that drops to 80%, and then it drops 20% every year until 2027 when it's zero. And so just something to keep in mind, if you're building new construction or you're looking at purchasing an asset, if you can close on it and get it in service this year, you'll be able to take 100% bonus versus if you were to do the same thing next year, it would be 80. I mean, and 80 is still very good, but if you want to take advantage of the 100% bonus, those are kind of the sunsetting dates on bonus depreciation. All right, let's see here. I do want to talk a little bit about two other energy credits that are often probably two of the most overlooked, to be honest with you. There's the 45L tax credit and the 179D tax deduction. The 45L tax credit is actually one that was not extended for 2022. So this only applies to properties that were constructed up until 2021, unless they change the law, which is still very possible. So these tax credits are one of the few things that gets bipartisan support in Washington these days. You've got the Republicans who are looking for tax deductions, so they're oftentimes will support these energy credits. And then you've got the Democrats who are looking at green energy initiatives. And so oftentimes this gets bipartisan support. So it wouldn't surprise me if this bill does get extended, but currently it has not been extended for 2022. But these 45L energy credits would be for any residential property, any dwelling where somebody lives under 3 stories above grade. You get a $2,000 credit per door, potentially if the construction is energy efficient. So you do have to have it certified by a third party, but they go in and they look at the heating and air, they look at the ductwork, they look at the windows, they look at the insulation. And if you're eligible for these credits, it's a $2,000 tax credit per door. And so that's important. That's a tax credit, dollar for dollar, not a tax deduction. So a tax credit means if after all my income minus all my expenses and my tax bill is $30,000, I would only pay $28,000 if I built one of these homes. But you start to think about this in multifamily settings where you've got a fourplex, that's an $8,000 credit on a fourplex. So if you owe $10,000 in taxes, but you built a energy efficient fourplex, you no longer have to pay $10,000 in taxes. Now you're only paying $2,000. And so again, a lot of builders take advantage of this credit, but there's a lot of builders that we've come across at our time of doing these studies where it's like, oh, I've been building homes since 2015. I build, 150 homes a year and I've never heard of this. And it's like, oh, well, you've left some money on the table. Let's get you all caught up here. So definitely something to look at if you're into new construction or if you're into development. It can apply to renovated properties, but typically for it to apply on renovated properties, you kind of have to take the property down to the studs and upgrade the insulation, upgrade the heating and air, and then you may be eligible for the credit. So again, what kind of properties are eligible? It's anything where people live. So your apartment buildings, condominiums, assisted living, student housing, townhomes. Again, just remember it has to be under 3 stories above grade. So if it's above 3 stories, it applies or it's eligible for a different tax credit, but for the 45L, it has to be below 3 stories. I mentioned that. The 179D is a little bit different. This is for commercial properties. This also applies to large apartment buildings that are over that 3-story limit. This is a tax deduction of $1.80 per square foot. And this is nice because unlike the 45L where it's all or nothing on that $2,000 credit, the 179D can be broken up into 60-cent chunks. So you're eligible for heating and air or mechanical for 60 cents. Your lighting is 60 cents, and then your building envelope, which is your insulation and your windows, is also eligible for 60 cents. So if you've got really nice windows, but your heating and air is not great, you may still qualify for the 60 cent per square foot, but it's up to $1.80 per square foot. And very similar to the 45L, as long as it's more energy efficient than previous year's standards, and it depends on when you put it into service, then you're eligible for this. So it does have to be certified by a third party, but we would come in, we look at the property, we say, oh yeah, this is, LED lighting and high efficiency heating and air. You've got good insulation in the attic. There's certain things we're looking for. And if it qualifies, it's $1.80 per square foot. Now this is a deduction, which is different than the credit. So again, if we give $1.80 per square foot, that comes off your taxable income. That's not off your tax. And so that's a big difference. The nice thing about the 179D is we can go back and we don't have to amend any prior year's taxes. We can go back and do this retroactively. So I'll just kind of close out here, Dave, with just some of the new administration. We know that there's going to be some changes to the tax law. My guess is taxes are going to go up in some capacity. We don't know what's going to happen for sure. I think they're still trying to work through this coronavirus, and I think they've got some other things they're dealing with before they get to taxes. So I don't know if it'll happen in 2022. My guess is probably not. But corporate tax rates are going to go up, this is what they're suggesting. This hasn't been passed yet, but this is what they're suggesting. Corporate tax rates going up from 21 to 26.5, a 3% surcharge on adjusted gross income over 5 million. So that applies to you, Dave. long-term capital gains could go up from 20% to 25%. Tax rates for high income earners go up to 39. Right now, the highest tax bracket is 37. So that could go up to 39.6. Now, 1031 exchanges and bonus depreciation were talked about, but they're not mentioned in the recommendation from the Ways and Means Committee. So I don't think anything's going to happen with 1031 exchanges, which is good for real estate, because I think that would really hurt the number of transactions. But so far, no word of anything happening to 1031 exchanges, and also nothing happening with bonus as of right now, other than that sunsetting that I mentioned earlier. So looks like we've got a question here. Let me open up the chat here.
Yeah, I can read it. It's Tiffany who's asking, can you refer me to a real estate tax professional that can do my taxes? And I was just starting to type in response that often depends on what state you are in. So, I mean, I know some people, but they only do for their, oh, she said she is in Georgia.
Perfect. Yeah, I actually, I can recommend a few. My contact information will be here on the end, Tiffany. So just reach out to me, or Dave,
Great.
if you've got somebody in Georgia. I've got a few CPAs that we work with who work with clients all over the country that kind of specialize in real estate.
Right. I do not in Georgia, but that actually leads right into one of the questions I had standing by, asking if kind of what's the difference between you and a CPA? Kind of like, where do you fit in? Do I need both? And all
Sure.
that, which that fits right in.
Yeah, no, that's a great question. So we partner with CPAs. CPAs have the tax knowledge, but they don't have the engineering side to be able to break apart a building or the construction knowledge. And so we work with CPAs all over the country. They partner with us and they say, hey, I've got a client who owns real estate. They've got a big tax liability. Can you do the cost seg study for us? And so we always want to work hand in hand with your CPA. We don't file or do any taxes here at our firm. We just do cost segregation. It's kind of a specialty niche. I always compare it to like your general practitioner and your heart surgeon. You know, we're kind of the heart surgeon where we just focus on this one thing, which is depreciation, but we do want to work in conjunction with your CPA to make sure you can use the deductions, make sure that it makes sense, because they have a bigger picture of your overall health, you know, to use the analogy. And so we always want to work with your CPA or tax preparer, get them involved early so that we can make sure we're on board and make sure that you can utilize those deductions. So great questions. And it looks like somebody else was looking for a CPA recommendation in Philadelphia. So again, I actually just proceeded to the next slide. It's got my contact information in there down on the bottom right. But if you don't mind shooting me an email, I can respond and get you contact information for CPAs across the country that specialize in real estate. And
yeah, that'd be great for helping our members, Eric. And in fact, I know what you could do. They email you, and then you could even email to your contact. Then they have everybody's information right there. So
no, that's a great idea. So
yeah, thank you. You know, one of the questions, and just while it's kind of fresh, that came in from Tim when you were talking about the per square foot deduction a couple of minutes ago. So he asked, when you're doing that, or when that applies, is that just for the interior, or is that for the square footage of an entire property? So I guess he means if you have a 10,000 foot lot, but 7,000 feet of it's the rooms, and the other 3,000's the garden, or the
right,
the lawn, then what, where does that, how does that work with square footage?
Sure. So that applies to the interior portion. So with the exception of parking garages sometimes will qualify, usually just for the lighting portion, because there's usually not heating and air in a parking garage. So parking garages may qualify for the square footage of the parking garage. We may be able to get 60 cents for the light if they're energy efficient, but typically it's just for the living space, not the actual lot size.
Okay. Also, I guess getting into more questions, you were talking earlier about sometimes, with energy discounts, and especially now with solar panels and a lot of the solar energy. I know, we're hearing a lot at REI USA, especially about, those types of things, and that it can lead to savings and discounts. But maybe if you wouldn't mind, I guess to kind of rephrase the question, maybe elaborating on that, what are some things that we as investors should watch for in terms of those discounts as they might apply to cost segregation?
Sure. So in terms of cost segregation, solar panels are typically 15-year assets. So if you were to buy a building that had solar panels or solar equipment on it, we would put a value to that equipment and you would be able to depreciate that over 15 years, which under the current tax law is bonus eligible, which means you get to take 100% of that deduction in the first year. So that's different than an energy credit. I know different states, I even think at the federal level, there's credits for installing solar on your rental properties and whatnot. But just strictly from a cost segregation standpoint, those are treated as 15-year assets, 100% bonus eligible. So with that deduction plus the state incentives, oftentimes you get a huge write-off and, can offset the down payment of that stuff just by taking advantage of the credits and the ability to depreciate that over a short period of time.
All right, thank you. That's another great answer, and I'm just actually processing the next question that I've got here. So, okay, getting the gist of it, and we get into, and this is interesting too, at what point do we or does an investor contact you? In other words, they're ready to sell the property, they've just purchased it, they're looking into the purchase, and there might be reasons for all of those. But
Yeah.
when's the ideal time for you to be able to step in and say, okay, hi, here's what here's what you need to do?
No, that's a great question. And you're exactly right. It could be at any of those stages, really dependent upon what your income level is and if you're at a tax liability. If you owe taxes and you own real estate, definitely worth looking into. Part of what we do is a free benefit analysis on any property, and we've got the information there on the screen where we'll look at it for free and say, hey, based on the information you've provided, we anticipate saving X amount in taxes. Here's what our fee would be. And then you can work with your CPA, or we can get on a call with your CPA and kind of strategize on how to implement those deductions. And if it makes sense this year, or maybe it makes sense next year because you're going to sell a property and you've got a big capital gain you need to offset the next year. So again, it's not always a matter of if, it's just a matter of when. And there's always, if we had a crystal ball and I could say, and I knew what your income was going to be in 5 years, and I knew what the government was going to do with tax rates in 5 years, there's an exact time where we can maximize these deductions. But obviously we don't have that information. So we just have to use it to the best of our ability and say, okay, typically my income stays about the same, but I've got a tax liability this year for one reason or another. I've got fewer deductions or whatever, what have you. We would look at it and say, okay, you just bought a property, or sometimes we tell people, go buy a property at the end of the year. You're going to have a huge tax liability, go buy an asset. And sometimes you can get much of, or a good portion of your down payment back by doing a cost seg study. So you can either write the check to the IRS or write it as a down payment on a new investment property that's going to cash flow. So, that's a great question. I don't have an exact answer. It could be all of the above. When you sell a property, if you've owned one, but now you have a tax liability, or oftentimes we work with potential buyers who are looking at 3 different assets and they say, hey, from a cost segregation standpoint, Eric, which one of these would be the best? I'm looking at a car wash, I'm looking at a multifamily, and I'm looking at a storage unit. And we can run some preliminary numbers and get back to you so you can factor it into your ROI and what your return is going to look like, and use that as a factor in there. So great question.
All right,
Dave,
we will go ahead.
I was just going to say my contact information is there. So feel free, if you do have a property, feel free to use us as a resource. We don't charge by the hour or anything like that. If you've got a question on depreciation, or you're looking to possibly get a cost seg study and you want some information on what the numbers might look like, feel free to give us a call. We'll do a no cost analysis, and then you at least have the information to make an educated decision.
Okay, and we'll mention that cost seg study means cost segregation. study, just so somebody doesn't think that's a name. Next question ties right in. You were just mentioning about if you have a car wash or self-storage, was what happens with regard to a portfolio? Maybe somebody does have a shopping center and a self-storage and an apartment building or whatever the case might be. So are you able to, is it what you do, I guess they're saying, is it based on the total amount involved in each property, or because of the deductions, does each one get treated separately, or how does that work when someone has a kind of, I guess we'll say, a diversified portfolio?
Yeah, so the work is all done based on the size and scope of each project. So each tax parcel will be treated separately. And so we would do, if you had 3 properties, even if they were across the country, you basically would need 3 individualized reports. Obviously, there's some economy of scales from a pricing standpoint that we offer discounts for multiple properties. But it would require that we do 3 different studies. And the reason for that is if and when you sell off one of those assets, you would need a single report to be able to adjust the numbers on the back end. So, yeah, so you would have a separate property. It's good to, one time, what we'll typically do on that is, let's say you've got 10 properties, Dave, we'll do an analysis on all 10 and give it back to you. Now you have some numbers, so you can say, okay, I'm going to do these 2 this year because this gives me my biggest bang for my buck. And then next year I'll do these 3, and then next year I'll do these 2. You don't have to do them all at once. You can kind of pick and choose. And that's, like I mentioned earlier, that's one of the great things about cost seg is it's very flexible. Get to just kind of keep it in your back pocket. And when you've got those high income years, you pull it out and play that card at that time.
Okay, and we've got one more, so it times out pretty well here. Asking about if you were to decide to do a 1031 exchange, does that affect things? Or if so, how does that affect things? Or would having a cost segregation plan prevent you from doing a 1031 with that particular property?
Great question. So no, it doesn't affect it at all. And you can do a cost seg study on a property you think you might end up 1031 exchanging. What ends up happening is, again, it's just a deferral vehicle where you're deferring your capital gains and your depreciation recapture. One thing that does happen is you will have a smaller depreciable basis on the new asset because you've already accelerated your depreciation on the previous or the relinquished asset. So that gets pushed over. So if you've taken $200,000 of depreciation over here, you have to account for that in the new property. And so as long as you're exchanging into larger properties where you're adding additional capital, cost segregation works very well hand in hand with 1031 exchange. It doesn't prevent you from doing it at all. Works very well.
Okay, very good. That is it on questions. I will just think here, just for the couple of minutes we have left, Eric, maybe just to kind of do a little bit of recap of times that an investor, especially a newer one, should be thinking in terms of cost segregation. Is it the, hey, I'm thinking I'm selling, should I look to sell by the end of this year, wait till next year, the buy and hold, kind of what are some good beneficial scenarios for investors to start thinking along the lines of, hey, I better call Erik?
Sure. So if you're looking at properties where you think you're going to hold them for at least a 3 to 5 year window, definitely look into cost segregation. So if you're going to buy a property and you intend on flipping it and selling it the following year, cost segregation typically doesn't make sense in that scenario unless it's a high value property. Because if it's at a high value, if it's a $5 million asset and you buy it this year and you sell it next year for 7, remember, we have that rate arbitrage where we talked about taking your deduction at a high rate, paying it back at a lower rate and saving the spread. And so in those scenarios, you can save significant tax dollars, even holding it even a single year. But typically, if you're going to hold it, the longer you hold it, the bigger your benefit becomes because of the time value of money element. And so, if you're buying an asset, your intent is to hold it long term. A lot of investors just get the numbers run for them right when they buy it or when they're looking to close. So they have that information. And then again, use it as a tax bracket management tool to manage your tax brackets. And that's kind of when you play that card is when you need the deductions to manage your tax bracket and get you into a lower tax bracket.
Okay, no, thank you. That's a great explanation. It's kind of like, and I have this discussion with realtors a lot on the marketing side, is there's a difference between, are you as a realtor looking for a homeowner that is thinking of selling or a homeowner that's ready to sell?
Right.
And of course, some realtors will say either one, I don't care, but there's a difference in what you do with either scenario. And so I
Right.
think that's,
Absolutely.
definitely the way to apply that. So, all right, we're good on questions. Erik Oliver of Cost Seg Authority, we thank you so much for all your great information, answering all the questions. Thanks to our members for asking all the great questions. That'll do it. We will be having this, will be available on replay. And again, everybody, thanks for your participation. And we thank you again, Erik, on behalf of REI USA.
Yeah, no, thanks for having me, David. It's always a pleasure. You have a great day.
All right, so we've got Erik's contact info is on the screen. So going once, going twice. Thank you, everybody. Good luck.
Thanks, Dave.
All right, you bet. Yeah, we've had a good group, so.
Perfect.
Good
No, I
deal.
appreciate the time and great questions as always. Let me
Okay.
know if you need anything on my end, but I
Will
appreciate your
do.
time.
All right, you have a good